Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, we need to talk about McDonald's because they are planning a round of layoffs, and we need to figure out why McDonald's is doing this and does this mean anything for the broader economy? Because as you know, because you like and subscribe and comment all day, Monday through Friday on this here channel, that the majority of companies that we have talked about and that have made headlines have all been in the tech space. Meta, Microsoft, Alphabet, aka Google, Amazon, all 10,000, 15,000, even 20,000 person layoffs every single time, which is massive. That is huge. But in terms of the economy, not all that big of a deal, even though for those laid off, that is a traumatic experience. Only one company that I can come up with, which is Disney, is the only company that has announced 5,000, I think it was 5,500 person layoff, and they aren't necessarily in the tech space. Only one I can come up with until today. So, what is going on at McDonald's? So first, I think it was a Wall Street Journal that came out and said that they're telling their corporate employees, don't come into work. Y'all can work from home Monday through Wednesday, and at some point virtually they're going to find out whether or not their job has been moved or cut, which is, I think, an unfortunate circumstance. We got to sit at home and just worry about this for 3 days. Could have been handled differently if you ask me. However, when we look at the business, is McDonald's struggling? Are they okay? What is going on here? Because unlike tech, you could probably see that coming. If you really sit down and think about it, going back to the pandemic, everybody, particularly tech companies, everybody was working from home, people were ordering more stuff, you had to hire aggressively to keep up with the demand, which is one reason how we got into the inflation crisis. Makes sense. Now we're out of the pandemic, people aren't shopping as much as what they were, people are out there spending money in other places other than just online shopping. You might have to cut back to adjust for where demand is. Not fun, but it makes sense. Well, what about McDonald's? What did they do? Right? What happened here? Here's what we know. Number one, McDonald's employs 45,000 people at the corporate level. Remember, McDonald's, yes, they have, the restaurants, but those are primarily owned by individual franchisees. People richer than me and you, but not like superstars. I think it costs anywhere between $2 to $3 million to get a McDonald's. Again, money I don't have yet, but much more attainable than a billionaire. In either case, though, you're not really going to see any changes or layoffs there in most cases because those things are somewhat separate. But at the corporate level, the people who set a lot of the prices, a lot of the branding and marketing and all that kind of stuff, those are the people who are at risk at this point in time. Now, with all this news, the first thing I thought was, let's go back and look at McDonald's. Are they consistent? Are they losing money? What happened? One thing we know is that it did happen is food prices have gone up. Inflation has hit McDonald's, and when you were selling fries for $1 and it cost you 50 cents, well, as that cost starts creeping up, that cuts into your bottom line. That is one thing. However, McDonald's is more profitable, at least in the fourth quarter, than where they were last year. So they announced earnings not too long ago, and they are 16% more profitable from Q4 2021 to Q4 2022. So what is going on here? I want to show you this here, and you'll see their revenue, their sales, and their net income. All of that stuff is relatively solid. I don't see anything that stands out that says, oh my goodness, we need to cut costs, something is going on here. Now, here's what the CEO said, or what they at least hinted towards, is that they are looking to prepare in case there is a recession, which means that their sales could dip and they want to start to be proactive and cut costs. This is what we talked about last year when we talked about a self-fulfilling recession. Right now, yes, I know inflation is high. Okay, yes, I know a bank or two has failed, but right now our unemployment rate is right around 3%, which is historically low. 3% unemployment is good. Okay, you prefer it to be full employment where anybody who wants a job can have a job. Conversation for another day, but 3% is low. Okay, during the pandemic, it was much higher. I think we were close to like 10 or 15% or something of that nature, something extremely high, 2 or 3 times higher than what we were now. But estimates are coming in now that by the end of 2023, we could be at 5%, which doesn't sound like a lot, a 2% increase, but that is a lot. It's almost double. I know we're kind of rounding off math here from 3 to 6, but going from 3% to 5% is something that you would notice once you start to see friends and family get, cut and lose their jobs. It's not a fortunate thing to say or think about, but it is a reality, and that could be what's happening here at McDonald's, because again, sales, you saw the numbers, they were solid. You saw net income, their profits were solid. Their demand is okay. Inflation is going down, yet they're still looking to cut, which could have some knock-on effects down the line. The other thing too is we don't know how large this cut is going to be. I don't imagine it would be, 10% of staff. I also don't know. This is a guess here. Again, 45,000 people are employed at the corporate level. So that is the number that we're looking at. Again, not looking at the franchise level. We don't really see, we don't really expect to see anything there. Those layoffs will be announced literally location by location. You wouldn't get a huge bulletin or anything like that to tell us what was going on there. But this is, I would say, a medium flag here. Depends on how many people they decide to let go, if they decide to do it at all. They could change their mind. You never know. But I would say this is a yellow flag because we knew the tech stuff, all that made sense, but then Disney cut 5,500 and now McDonald's, both not in tech, but are cutting, even though McDonald's doesn't make sense to me personally. Disney kind of did, because Disney was trailing off, was losing a lot of money via Disney Plus, and they even had a change in CEO. So Disney sort of makes it, I can squint and say, okay, I see why you're cutting costs. McDonald's, not so much. And that whole self-fulfilling recession thing is at least raising an eyebrow in my mind. Now, all that to say that this does not mean that, A, we're going into recession. It could be, but it's not necessarily a telltale sign. But also doesn't mean that the stock market is going to tank. Because of stats like this. Just because you go into a recession and just because there is a recession does not necessarily mean that the stock market is prone to fall or is definitely going to fall off a cliff. That's a natural reaction that we tend to have. But the stock market already fell last year. And I really think, and you're probably on the same page with me, because the stock market was preparing for a recession for so darn long that now we've already priced that in and we're good to go from here. Okay, from a stock market perspective. Remember, even back in 2020, we had the coronavirus pandemic and the stock market tanked. We ended up still making money from January to December of 2020. That was a recession and the market was still up. Now, not every recession is the same. Just because it happened in 2020 doesn't mean it's going to happen in 2023. But the math is the math. And as you saw in that tweet, a friend of mine had put that out. The year before a recession is usually the worst year. The year of the recession might not be all that bad. So hopefully we don't go into recession and the stock market just stays up. But I did want to throw that out there. This could be one of those times where I'm telling you right now, don't panic. I'm pre-telling you not to panic, which has always been my message anyway. But y'all get it. Don't panic if this is the route we're going to go, and you obviously know to protect yourself at all times, not just in the boxing ring, but primarily from a savings and investing point of view. We talked about how the most important savings vehicle or most important investing vehicle is your savings account, because unfortunately, should you lose your employment or source of income, you want to be able to pull from a cash savings before you pull from your investments for tax reasons and for future investing and wealth reasons. You want to have that buffer there and have it for at least 6 months, a year if you want to stretch it out that far. Then you want to move towards your investments and be defensive there. Don't be overly allocated or what they call overweight in a certain position or in a certain stock. Yes, companies like Nvidia are up 90% in 2023 already, and we just passed Q1. That does not mean that I am going to change my investment philosophy and go from what I say I always limit myself to 5%. I'm not going to say, oh, let me push 30% of all my money into one stock because it's hot right now. You don't want to do that because we don't know what's around the corner. We still have that debt ceiling thing that's out there that nobody's talking about right now. I'm going to still do a breakdown video on that, but it's there, right? There are still risks out there. So you still want to protect yourself, still continue investing, still continue to dollar cost average, but be ready for the perhaps unexpected. Some people expect it, some people don't. But I'm telling you now not to panic. Keep your eye out for opportunities and always protect yourself, because this, I don't want to be the fear-mongering recessions around the corner guy, but I'm telling you not to be shocked. That's what I would prefer to say. Don't be shocked if it happens. Be ready if it happens. I think that's the best position for you to be in should this be the case. Again, 45,000 employees at McDonald's total. That's not the layoff number. That's not a whole lot when you compare it to the millions of jobs that create the U.S. economy. So, always kind of weigh it a little bit with a grain of salt and be very careful. If we start to see dozens of these that are not in tech, then I would start to be, go from red flag to like an orange flag before I hit to red. So that's how I'm kind of viewing it. View it with patience. View it with defense in mind as you're looking through it, and just continue to survey and stay on track. Those who are dollar cost averaging 3, 4, 5 years ago are looking pretty nice right now. Don't forget that. Okay, a lot of people start their investing, see something crazy, sell out, panic, and then turn around and look and say, oh my goodness. Another example for Nvidia, if you go back to early 2022, we did a video. I'm doing this from memory. If you go back to, I think it was January 2022, did a video on Nvidia where they announced earnings. They had the best period, the best earnings quarter in 10 years, and the stock dropped like 7 or 8% or whatever it was at that point in time. And look at where the stock is now. I said back then that was a buying opportunity. So again, continue not panicking, continue dollar cost averaging, and stay in the path, and more often than not, you're going to be in the right space. Okay? Now, moving on to announcements. Number one, you're going to get, it'll likely be tomorrow. So I've done about half of our reading schedule for the Intelligent Investor. I'm just really trying to break down, you know, if people be reading on different levels, and it's a big book. So I need to break down like what makes sense from a teaching perspective and a discussion perspective. So I want to put out like a link that way we can all sign up on an email list and figure out where everybody is in the book, and then like put out like, hey, we're going to meet at this time, YouTube live or something like that. So that's number one. You'll be getting that probably tomorrow on public and also on the YouTube post channel. So make sure you subscribe. That way you can see when it comes out. Okay, so that'll be coming out tonight. Number two is, I don't know why I'm counting this way, but number two, I'll be out next week. So everything is going to be, most of the things next week is going to be pre-recorded. I'm going to Disneyland or Disney World, whatever one is in Orlando. Anyway, so I'll be out, but I'm going to have everything pre-recorded. If you want me to cover something, this is the time to let me know so I can record it this week and then come out next week. So we'll have all 5 videos Monday through Friday. Okay. This is your time to let me know in the comments so I can make it now. I know somebody wanted me to break down the US debt. That's already on cue. That's one of the videos I can do. It's going to be quote unquote timeless in that it doesn't have to do anything with the news cycle, at least we hope. So if you got something for me to cover, let me know. For our members, there is a stock that we're going to break down. ANSS is a ticker symbol, so you can feel free to look that one up. I'll be recording that one either tonight or tomorrow. That will drop inside our members only. So those are the announcements, okay? Members only. Video dropping on ANSS, that's the ticker symbol. That'll be dropping this week. I'll be out next week. Let me know what you want me to cover. And then book club will be announcing. I'll give you guys a link to sign up so we can just have where everybody is. And I'll put out a schedule, a tentative schedule on what we're discussing, how many chapters we're reading as we go throughout the entire book. All right. That concludes today's segment and show. All right. So I will talk to y'all later. Don't forget to like and subscribe. All right. Whew. Bye.